This video and linked spreadsheets provide the weekly history of the silver-gold ratio, gold-platinum ratio, the contracts we're trading to capture these moves, how to work with the linked spreadsheets, enabling you to instantly calculate the risk and reward trading any ratios of these metals up or down, and let you track two of my current positions, enabling you to better understand the risk, reward, and all costs associated with these trades. Position, silver gold. I'm in at 100.12 ounces of silver to buy 1 ounce of gold, and I'm expecting this ratio to move lower. I've allocated $12,500 per position. My exchange margin requirement per position is $3,000. 1975 through 2025 average for this ratio, 62.77 ounces of silver to buy 1 ounce of gold. All-time high, 126.15 to 1. All-time low, 16.15 to 1. Again, I'm in at 100.12. Expecting this ratio to move lower to be more in line with the 1975 through 2025 average of 62.77 to 1. I've capitalized the position to withstand a move above the all-time historic high of 126.15 to 1, all the way up to 133.40 to 1. If this occurs, the $12,500 I've allocated for this position will have a liquidation value of $3,020. But I won't have a margin call on anything below 133.41. My long-term objective on this trade is 62.77 ounces of silver to buy 1 ounce of gold. At 62.77 to 1, the liquidation value of my $12,500 allocation would be $33,209. And I'm not concerned about how long it takes because I've structured this trade where my carry costs on my leveraged amounts are literally less than zero. Gold platinum. I'm in at 0.33 ounces of gold to buy 1 ounce of platinum, expecting this ratio to move higher. I've allocated $100,000 per position, of which $80,000 is in a treasury bill earning me interest. My margin requirement on this position is $7,500. However, some member firms may not give you spread margin rates and may require you to post $15,000 or more. It really depends on what kind of relationship your brokerage team has with their member firm. 1985 through 2025 average for this ratio, 1.19 ounces of gold to buy 1 ounce of platinum. All-time high, 2.4 to 1. All-time low, 0.29 to 1. This was put in on the 25th of April, 2025. Again, I'm in at 0.33 to 1, expecting this ratio to move higher to be more in line with its 1985 through 2025 average of 1.19 to 1. I've capitalized each position to withstand a move below the all-time historic low of 0.29 to 1, all the way down to a ratio where 0.18 of an ounce of gold could buy 1 ounce of platinum. If this occurs, the $100,000 I've allocated per position would have a liquidation value of $7,529, but I'm not going to have a margin call on anything above 0.17. My long-term objective for this ratio is where it takes 1 ounce of gold to buy 1 ounce of platinum, which is 0.19 below the 1985 through 2025 historical average of 1.19. At a ratio of 1 ounce of gold to buy 1 ounce of platinum, the $100,000 I've allocated per position for this trade will have a liquidation value of $477,520. And I really don't care how long it takes because I've structured this trade where I have less than zero carry cost on my leveraged amounts. And I posted treasury bills to satisfy my margin requirements that I'm earning interest on. The contracts we're trading to capture the moves in this ratio are traded on the Chicago Mercantile Exchange. The CME is the world's highest dollar volume commodity and financial futures exchange. Gold has three contract sizes: 10 ounce, margin requirement, $1,650. 50 ounce, margin requirement, $8,250. 100 ounce, margin, $16,500. Silver, 1,000 ounce, margin, $3,300. 2,500 ounce, margin, $8,250. 5,000 ounce, margin, $16,500. Bid-ask spreads on CME metals contracts are the tightest on the planet. For example, gold averages 25 cents per ounce. Currently, that's 0.00752% of contract value. Commission costs, which include all exchange, brokerage, and regulatory fees, should be less than $25 per contracted entry and $25 at liquidation. The move it takes to cover all costs on a gold trade should be less than 75 cents per ounce. This includes all bid-ask spreads, exchange, brokerage, and regulatory fees. For example, if you bought gold at $3,324.25 per ounce, all your costs in and out of the market would be covered by a 75-cent move up to $3,325 per ounce. Cost of leverage. CME gold contracts have no interest charged on the leveraged amount because they're agreements to buy or sell a specific amount of gold on or before a specific date. I'd like to emphasize that you can trade in and out of a CME contract as many times as you'd like, long or short, 23 hours a day prior to the delivery date. On CME contracts, although you're not paying any interest on leveraged amounts, if you're long the market, there is a cost to carry built into the forward pricing. If you're short the market, you're getting paid that carry. Let me walk you through it. First, how to calculate the carry. In this example, the August 2025 delivery is trading at $3,354.90 per ounce. The August 2026, $3,509.80 per ounce. This $154.90 per ounce premium is the carry that's built into the forward pricing. This equates to a leverage cost of 4.62% annually, but only on long positions. On short positions, you're getting paid this 4.62% annually. I'd like to emphasize that you're only paying this carry on long positions. On short positions, you're getting paid the carry. Let's compare the 4.62% to what cash brokers charged on leverage amounts. At the time of this report, reputable brokers were charging between 5.83% to as high as 12.7%. The dark side of the brokerage business, 20% or more. And you're paying this rate on long and short positions. Versus a CME trade where you're paying 4.62% on long positions and getting paid 4.62% on shorts. What can be used to satisfy CME margin requirements? Well, U.S. Treasuries, foreign sovereign debt, certain listed stocks, and many other instruments. In other words, if you have $1 million in your account, $850,000 could be in Treasury bills earning you interest. If your margin requirements on your account were $650,000, there'd be no issues. Treasury bills are the same as cash when it comes to CME margins. Delivery. CME contracts can be delivered, enabling you to take physical possession of your gold with a guarantee of purity and fineness. Safety of funds. When your money is held by a CME member firm, it's in a segregated account in your name and guaranteed plus or minus trading activity by the Financial Safeguard System. For over 160 years, the Financial Safeguard System has protected customer deposits. In the event a member firm becomes insolvent for any reason, including fraud, your positions are immediately transferred to another member firm and balances are normally restored within 48 hours. When it comes to transparent pricing, transaction cost, liquidity, ability to short, carry cost, margin requirements, and safety of funds, nothing can compete with a CME contract. Let's get down to the risk reward of trading this ratio. Using the linked spreadsheet with 7 entries, you can immediately review any potential outcome trading any ratio of gold versus silver at any price, trading this ratio up or down. Let me walk you through just how easy it is. Let's start by downloading and opening the spreadsheet. Next, enable editing, which should automatically reduce the view size to 53%. Open the link in I6 for current gold quotes and I8 for current silver quotes. Trade entry prices go into cells J6 for gold and J8 for silver. Contract sizes and specifications are linked in cells I45 through I50. Enter the number of ounces you want to trade in cell J10 for gold and J12 for silver. Enter a positive number for a long position and a negative number for a short. Enter your start balance in cell M40. Enter any percentage change up or down for gold in cell M35 and silver in cell M37. Your gold-silver entry ratio shows in cell P41. The ratio generated by your percent change entries shows in cell P44. Entry position valuation for gold shows in cell J30 and silver J32. Difference in entry position valuations shows in cell J34. Position valuation generated by your percent change entries for gold shows in cell J38, silver J40. Difference in position valuations shows in cell J42. Profit or loss shows in cell N44. The chart to the right of the percentage change table shows your start balance, margin requirement, profit or loss, account liquidating value. You'll find the 1975 through 2025 weekly historical data for gold and silver in columns D and E, weekly position valuation in columns F and G. 1975 through 2025 weekly gold-silver ratio in column C. Top center chart gives you the 1975 through 2025 weekly valuation of your silver position, your gold position, and the 1975 through 2025 weekly difference between your gold and your silver position shown by the blue line, relative to the gold-silver ratio shown by the green area chart. Top right, 50-year chart for gold. Silver, relative to the gold-silver ratio in green. Lower right, the weekly 50-year ratio chart with the disclosed fundamentals and prices for the major market moves. Let me start by zooming in, and I'll walk you through a trade. Start by opening the CME Gold link in link cell I6. You'll find current exchange quotes for gold. Enter the current price for gold in cell J6. Open the exchange quote page for silver in I8. 10-minute delayed quotes for silver show. Enter the current price for silver in cell J8. Your entry gold-silver ratio shows in cell J14. In this example, it's coming in at 100.12 ounces of silver for every 1 ounce of gold. Looking at the 50-year chart and the disclosed fundamentals on what's fueled the previous moves, let me zoom in on this. The current ratio of 100.12 ounces of silver for every 1 ounce of gold is pricing in political chaos or a fiscal crisis more intense than at the height of the 2008 federal debt and banking crisis of 93.65 to 1. And you believe the current ratio of 100.12 to 1 is overdone, and this ratio will decline to be more in line with the 1975 through 2025 average of 62.77 to 1. To bank on this ratio contracting, you need to short gold and go long silver. Contract sizes are listed in cells I45 through I50. For this example, I'm going to use the 10-ounce gold contract and the 1,000-ounce silver contract to trade this ratio lower from the current 100.12 to 1 towards its 50-year average of 62.77 to 1. We're trading the 10-ounce gold contract. In cell J10, I'm going to enter minus 10, which translates into short 10 ounces of gold. We're trading the 1,000-ounce silver contract. In cell J12, I'm going to enter 1,000, which represents long 1,000 ounces of silver. The margin requirement for this position will show in cell J15. In this example, it's a total of $3,000. Entry position values show in cells J30 and J32. The difference in the position values shows in J34. The weekly 50-year chart now shows the weekly value of your 10-ounce gold position, 1,000-ounce silver position, the blue line, the 1975 through 2025 weekly difference between them, relative to the ratio in green. Our entry of 100.12 to 1 shows in cell P41. Our position is balanced. Translated, we're short 10 ounces of gold at $3,328.30 an ounce, or we owe 10 ounces of gold that we need to buy back at a lower price than $3,328.30 to make money. And because we're short, we're collecting the carry cost on this $33,283. We're long 1,000 ounces of silver at $33.243 per ounce. On the $33,243 of silver we own, we're paying the carry on the $33,243. We're balanced. In this example, the amount of gold we owe and are collecting carry cost on is $40 more than the amount of silver we own and are paying carry cost on, making the carry cost on this position essentially zero. I'd like to emphasize we're controlling a $66,526 position with zero leverage cost. Total costs all in on this trade for bid-ask spreads, exchange, brokerage, regulatory fees, and carry costs in and out would be less than $100. Translated, if this market moves in our favor, all costs for this $66,526 position in and out of the market could be covered in a few minutes. Our exchange margin requirement for this position shows in cell N42. Currently, it would be a maximum of $3,000. First, let's look at the downside, enabling us to get a handle on how much money we need to allocate for this position at 100.12 to 1. Again, this trade is banking on a move lower from the current 100.12 to 1 to be more in line with a 50-year average of 62.77 to 1. Let's assume we're absolutely wrong. Military action escalates in the Middle East. The federal government enters into another debt crisis. At the same time, hundreds of over-leveraged banks become insolvent. There aren't enough buyers at Treasury auctions for the $10 trillion in downgraded federal debt that is maturing and needs to be refinanced, and the $1.9 trillion in new federal debt that needs to be sold at rates the federal government can afford to pay. U.S. federal debt is downgraded again. The Federal Reserve has to step in as the buyer of last resort. The Federal Reserve has to create another $7 trillion from and backed by nothing with key punch entries to buy trillions in federal debt at rates the free market won't touch, and trillions more in bad bank debt to keep the U.S. banking sector solvent. If this occurs, it'll be the third time the Federal Reserve has had to do this since 2008, and it would bring the total amount of Fed-created money to more than $14 trillion. Under these circumstances, we could easily take out the 2020 federal debt crisis and COVID scamdemic high of 126.15. Let's assume we didn't reverse our position and go with it. We just maintained the position and took the pain. Let's see what the damage would be. Our entry is 100.12. With the fundamentals we've just reviewed, the safe haven demand for gold could easily fuel the price higher by 12.5%. Enter 12.5% in cell M35. This 12.5% move would increase the price of gold from our 3328.30 short entry by $416.04 per ounce. to $3,744.34 per ounce, creating a loss of $4,160.40 on our 10-ounce short gold position. At the same time, these dismal fundamentals could easily decrease industrial demand for silver and fuel a decline in price of 12.5%. Enter minus 12.5% in cell M37. This 12.5% decline would reduce the price of silver from $33.234 per ounce by $4.16 to $29.09 per ounce, generating a loss on our 1,000-ounce long silver position of $4,160. This move increased the ratio from our entry at 100.12 to 128.73. Taking out the previous 2020 federal debt and COVID crisis all-time high of 126.15. Let's review the damage at the 128.73 new record high. The value of our 10-ounce short gold position increased from $33,283 to $37,443, creating a loss of $4,160.40. The value of our long silver position decreased from $33,243 to $29,088, generating a loss of $4,160. Total loss at the new record high, $8,315.75. To prepare for this adverse move up to a new record high of 128.73, I take the amount of the potential market loss at 128.73 of $8,315.75, added to the margin requirement of $3,000, and allocate a minimum of $11,315.75 for this trade. In this example, I'm going to round it up to $12,500 by entering a $12,500 start balance in cell N40. At $12,500, I'm covered with no margin issues up to a ratio of 133.40. The chart to the right of the percentage movement table will give you a snapshot of the trade result. In this example, the $12,500 start balance, $3,000 margin requirement, the loss of $8,316, and the liquidation value at 128.73 of $4,184. Now let's look at the reward side of this trade and assume we're right, and this ratio moves from our entry at 100.12 lower to be in line with the 50-year average of 62.77. One example of how this 62.77 ratio could occur is if the market perceived gold as being overbought relative to industrial metals like silver or platinum. This is also a great ratio to trade. Currently, the gold-platinum ratio is at 0.33 ounces of gold to buy 1 ounce of platinum. It's within 0.04 of its all-time historic low of 0.29. High for this ratio, 2.4 ounces of gold to buy 1 ounce of platinum. Historical average, 1.19 ounces of gold to buy 1 ounce of platinum. On the 27th of May, 2025, again it was trading at 0.33 ounces of gold to buy 1 ounce of platinum, 0.04 from its all-time historic low of 0.29. Gold overvaluation market sentiment relative to silver or platinum is a distinct possibility in 2025. Over the last 12 months, gold has rallied $957.60 per ounce, or up 40.98%. Silver during the same 12-month period was only able to grind out a 2.2% overall gain. Add in the fact that gold's price action is currently telling us it's tired and ready to take a break. Let's assume the roles for gold and silver reverse, and during the next 12 months, gold is only able to grind out a 4.7% gain. Enter 4.7% in cell M35. This 4.7% increase in gold would push the price on our short position from $3,328.30 per ounce, up by $156.43 per ounce, to $3,484.73 an ounce, generating a loss on our short position. During the same 12-month period, silver breaks out and spikes higher to catch up with the percentage increase in gold. Because of gold's lofty price, silver's secondary demand as a cost-effective safe haven kicks in and overpowers its unchanged industrial demand that suppressed its price over the previous 12 months. Silver moves higher by 67%. Enter 67% in cell M37. This 67% increase would push the price of silver from our long entry at $33.243 per ounce higher by $22.27 per ounce to $55.52 per ounce, generating a gain on our long position, which would put this ratio back in line with its 1975 through 2025 50-year average of 62.77. Let's look at the overall gain at 62.77 to 1. On our short gold position, it moved against us. We went from owing 10 ounces of gold worth $33,283 to owing 10 ounces of gold worth $34,847, generating a loss of $1,564.30. Our 1,000-ounce long silver position moved in our favor, increasing in value from $33,243 to $55,516 for a gain of $22,270. Overall gain on this position, $20,709. Trade summary. We allocated $12,500. Our margin requirement was $3,000. Our gain, $20,709. Putting our liquidation value on this $12,500 allocation at $33,209. Even though we lost money on our gold position, we made a far greater amount on our silver. I'd like to emphasize, all we're trading is the ratio, and we're doing this with a leverage cost of less than zero. Total transaction costs to initiate and liquidate this position were $66,528, including all bid-ask spreads, all exchange, brokerage, regulatory fees, and carry costs, less than $100, which would reduce the profit on this position when it's offset from $20,709 to a net gain of $20,609. Let's say you think this ratio is going to keep moving higher from the current 100.12 below past the federal debt and COVID crisis high of 126.15 up to a new all-time record high of 140. To see the risk reward of this trade, all you need to do is reverse the position by changing the -10 in cell J10, representing short 10 ounces of gold, to a +10, representing long 10 ounces of gold, and the 1,000 in J12, representing long 1,000 ounces of silver, to -1,000, representing short 1,000 ounces of silver. I'm not a big fan of banking on this ratio increasing from the current 100.12 to a new all-time record high of 140, but if I did take this trade, I'd capitalize the position to withstand a move against me to 50. Let's see what it would take to capitalize this position to withstand a move from our entry at 100.12 down to 50. For this to happen, gold would have to sell off by 33.39%. Enter -33.39 in cell M35. This would decrease the price of gold from our long entry at $3,328.3 an ounce by $1,111.32 to $2,216.98 per ounce. At the same time, silver would have to rally by 33.39%. Enter 33.39% in cell M37. This would increase the price of silver from our short entry at $33.343 an ounce by $11.10 to $44.34 per ounce. Loss at 50 to 1, $22,213. To capitalize this position, I'd allocate the potential loss of $22,213 plus the $3,000 margin requirement and allocate at least $25,213 for this trade. In cell N40, enter your start balance of $25,213. Trade summary at 50 to 1. We've allocated $25,213. $3,000 is committed to the margin requirement. Loss on the move from 100.12 to 50 to 1, $22,213. Liquidating value, $3,000. Now for the upside. For this ratio to move to 140 to 1, it would take a 16.61% rally in gold. Enter 16.61% in cell M35. This would push the price of gold from our $3,328.3 long entry up by $552.83 to $3,881.13 per ounce, while at the same time, silver would have to sell off by 16.61%. Enter minus 16.61% in cell M37. This would push silver down from our $33.243 short entry by $5.52 to $27.72 per ounce. Gain on the move higher from 100.12 to 140.01, $11,049.97. Trade summary. On our $25,213 we allocated for this trade, $3,000 was committed to our margin requirement. Our gain on the position, $11,050. Putting the liquidating value at $36,263. Trading this ratio from the current 100.12 to 140 just doesn't make sense because we have a very realistic risk of $22,213 to make a maximum of $11,050, which, given current fundamentals and pricing, seems very unlikely. One ratio I am betting higher is gold platinum. This ratio just put it at an all-time historic low of 0.29 ounces of gold to buy 1 ounce of platinum. This was put in the 25th of April, 2025. The 1985 through 2025 average for this ratio is 1.1 ounces of gold to buy 1 ounce of platinum. All-time high for this ratio, 2.4 ounces of gold to buy 1 ounce of platinum. This was put in the first week of January, 2001. I'm long this ratio at 0.33 ounces of gold to buy 1 ounce of platinum. I'm allocating $100,000, of which $80,000 is currently in Treasury bills, earning me 4.34% interest. My margin requirement is $7,500. At $100,000, I've capitalized for a move down to 0.18 ounces of gold to buy 1 ounce of platinum, which I believe is a ridiculous ratio, but it could happen, and I just don't want to have any margin issues. To see a 0.18 ratio, gold would have to rally by 20.43%, while at the same time, platinum would have to sell off by 35.8%. If this occurs, my $100,000 is now worth $7,529, but I still wouldn't have a margin call. Again, the 1985 through 2025 average for this ratio is 1.19 ounces of gold to buy 1 ounce of platinum. What I expect over the next 6 to 36 months is that this ratio will move to 1 ounce of gold to buy 1 ounce of platinum, which would increase the $100,000 that I've allocated for this trade to $477,520. Let me quickly walk you through this position. I've also linked the spreadsheet if you'd like to follow along. It works the same way as the silver-gold ratio spreadsheet. I'm currently short 50 ounces of gold. Price, $3,321.30 per ounce. I'm long 150 ounces of platinum. Price, $1,090.30 per ounce, which puts me in this position at 0.33 ounces of gold to buy 1 ounce of platinum. My exchange margin requirement on this trade is $7,500. Some firms may require up to $15,000 on this trade. It really depends if they recognize this position as a spread trade. Also, when this starts moving, which I believe it will, maybe as early as July or August, and valuations escalate, margins will increase, so be properly capitalized going in. The value of my short gold position at entry was $166,065. Because I'm short, I'm collecting the carry that's built into the forward pricing. The value of my long platinum position at entry was $163,545. Because I'm long, I'm paying the carry built into the forward pricing. I can't emphasize how important it is to balance your position at entry. This alone could decide success or failure of your trade. In this example, my position is balanced within $2,520. Because my short position is $2,520 larger than my long, my carry cost on this $329,610 position is less than zero. I'm actually collecting the 4.62% carry on the $2,520. Total cost of all bid-ask spreads, exchange, brokerage, regulatory fees to get me in and out of this trade are going to be less than $250. Again, I have no carry or leverage costs, and I'm earning 4.34% interest on $80,000 of the $100,000 I allocated for this trade. Let's look at the risk, so you know how I'm capitalizing this position. Let's assume I'm dead wrong. This ratio moves to a new all-time record low of 0.18 to 1. I didn't reverse it, I didn't liquidate it, I just maintained this position and took the pain. One scenario for this to happen would be if gold rallied 20.43% against my short position. If you're working with a gold platinum spreadsheet, enter 20.43% in cell M35. This would move the price of gold against my short entry at $33.21 up by $678.70 to $4,000 per ounce. At the same time, platinum would have to sell off by 35.8%. If you're working with a spreadsheet, enter minus 35.8 in cell M37. This would decrease the price from our long entry at $1,090.30 by $390.30 to $700 an ounce, moving the ratio from our entry at 0.33 down to a new all-time historic low of 0.18, with the value of our short gold position increasing from $166,065 to $200,000, creating a loss on our short position of $33,935. The value of our long platinum position would decrease in value from $163,545 to $105,000, generating a loss of $58,545. Total loss on the position at 0.18, $92,479.75. To capitalize this position, I take the potential loss of $92,479.75, add in the margin requirement of $7,500, and put up at least $100,000, of which $80,000 would be in Treasury bills earning interest. In cell N40, enter $100,000. Trade summary. On the $100,000 we allocated for this trade, $7,500 was committed to margin. Our open trade loss was $92,480. Liquidating value, $7,520. Now for the upside. Platinum is not only an industrial metal, but also a safe haven alternative to gold. 20 times more scarce than gold and far more expensive to mine, and has a fraction of the annual production of gold. In 2024, 3,300 metric tons of gold were mined, versus 190 metric tons of platinum. Historically, from 1985 through 2025, Platinum is sold at a 19% premium to gold. With the recent fiscal and global political uncertainty, demand for gold as a safe haven spiked the price higher. Speculative technical traders jumped on board, adding fuel to the upward momentum fire, leaving platinum and silver in the dust. The tenacity of this upward momentum created a record price aberration of 0.29 ounces of gold to buy 1 ounce of platinum. I believe this is overdone. I'm in at 0.33 to 1. In my opinion, this 0.33 is fundamentally and technically unsustainable. My read is this ratio will return to 1 to 1 within 6 to a maximum of 36 months. 1 to 1 puts it more in line with the 1985 through 2025 historical average of 1.19 ounces of gold to buy 1 ounce of platinum. One scenario where this ratio could correct back to 1 to 1 is if the roles of gold and platinum reversed, with the overall increase in gold slowing to 12.91% over the next 6 to 36 months. In cell M35, enter 12.91%. This would rally gold from our current short entry of $3,321.30 up by $428.70 to $3,750 per ounce. Because platinum currently is a far more cost-effective safe haven alternative to gold, it's platinum's turn to surge higher, to catch up with gold, and this historical aberration corrects. In cell M37, enter 243.94%. This would increase the price of platinum from our current long entry of $1,090.30 by $2,659.70 to $3,750 an ounce, increasing the ratio from our entry at 0.33 to 1 to 1 to 1, which would put this ratio more in line with its historical average of 1.19 to 1. In this scenario, the 50 ounces of gold we owed, worth $166,065, increased in value to $187,500, creating a loss on our short gold position of $21,435. While at the same time, the 150 ounces of platinum we owned increased in value from $166,545 to $562,500, generating a profit of $395,955. Overall gain on the trade in this scenario, $377,519.94. Trade summary. On the $100,000 we allocated for this trade, $7,500 was committed to margin. Our overall gain, $377,620, putting the liquidation value at $477,520. Let's look at one final scenario where this ratio could move to be more in line with its 1985 through 2025 average of 1.19 to 1. Let's assume politicians all of a sudden grow a conscience. We see balanced global government budgets, peace and harmony on the planet. This economic prosperity, peace and harmony motivate metals to sell off with tenacity. Gold sells off by 74.71% from our short entry at $3,321.30 an ounce to $840 an ounce. With global balanced budgets, peace and harmony, and glowing global economies, industrial demand for platinum mutes the decline from its already depressed price of $1,090 per ounce to 8.28%. This 8.28% decline would put platinum at $1,000 per ounce and move the ratio from our entry at 0.33 up to 1.19 to be in line with the 1985 through 2025 average, generating an overall gain on this trade of $110,520. Trade summary. We allocated $100,000, of which $80,000 was in treasuries earning us interest. We're controlling a position worth $329,610. The way we've structured this position, we had a leverage cost of less than zero. Total transaction costs, including all bid-ask spreads, exchange, brokerage, and regulatory fees, less than $125 when we initiated the position, and it'll be less than $125 when we liquidate it. $7,500 was committed to our margin requirement. Overall gain at 1.19 to 1, $110,520. Putting the liquidation value at $210,520. Spreadsheet summary. Both the silver, gold, and gold platinum spreadsheets have current quotes linked in column I. You can enter any number of ounces long or short at any price in cells J6 through J12. Experiment with any percentage change up or down in cells M35 and M37. Or you can enter any price in cells J19 and J21 and it'll instantly provide trade results. But using the J19 and J21 price feature disables percent change in cells M35 and M37. Your trade summary shows in the bottom center chart. If you have questions, contact me. I enjoy talking to people about markets and trading. My team may not be able to accommodate your account due to your regulatory jurisdiction or financial status, but we can refer you to a capable licensed broker at a member firm who can.